If you're here right now, either number one, you're afraid of running out of money in retirement, or number two, you're trying to protect your money from market losses. If either of those is true, you're in the right spot. If you're somebody who is looking for the greatest growth potential and the greatest risk, you are not in the right spot. What we are focusing on is helping people make sure they have a safe strategy to not run out of money in retirement. So for those of you that are more high risk, thanks for stopping by, but we are not going to be a great fit for you. But for the rest of you, you are in the right spot. Just to introduce myself, my name is Brandon Lenhoff, owner of Lenhoff Financial. I have 18 years of experience in the financial services industry. And 2008 was my very first client-facing role. That's when I got securities licensed. And I was working with a broker dealer and got thrown to the phones when people were losing a bunch of money. So super stressful way for me to get my start, but really eye-opening as well. I saw what happened to people, especially people that were close to retirement, and how it affected them. Those who were close had to push their retirement date out 7 to 10 years to recoup the funds that they had lost. And people that were in retirement either had to learn to live on a lot less income or go back to work. So 8 years ago, I started my brokerage, and we take a team approach. We have financial advisors that we partner up with to handle the growth side of our client's portfolio. And then myself and my team, we really focus on the safe side of the portfolio. And so you get a total team with your planning. Now, with that said, we take a safe bucket strategy approach, and I'm going to go through exactly how that works now. All right, now I'm going to go through our safe bucket strategy and how we differ from most financial professionals that you're speaking with. First of all, we are a virtual independent agency. So we handle everything virtually. We are across all 50 states. So when COVID hit in 2020, a lot of people didn't want to meet with us face-to-face anymore. Luckily, a lot of people learned how to do Zoom. And so ever since then, we have been helping people virtually. And what's nice about that is we can meet with our clients right from their living rooms. And we are an independent agency as well. So what's different about an independent brokerage versus a captive brokerage is we aren't tied to any one specific company. If it makes sense for us to take a contract out with a carrier for our clients, and if they offer good products and services for our clients, we go ahead and take out a contract with that company. So these companies can change from year to year, products can change from year to year. So we want to be able to offer our clients as many options as we possibly can. Now, when we all get to retirement, most of us are going to have a cash lump sum. Then we got to figure out how to turn that cash lump sum into an income stream, which can be difficult. Most of us are used to some sort of a paycheck our entire life. We aren't used to trying to budget from this lump sum of cash and hoping we don't run out. So the way it looks for people is you have your income during your career, then you have the cost of living going up with inflation, which I know everybody is seeing right now. And then you get to your retirement years. You have your highest earning years right before you retire. Then you do get things like Social Security. If you're lucky enough, you might have a pension as well. But those two things combined typically don't completely fill your income gap that you have there. Social Security definitely doesn't fill your income gap. So what our goal is to look at what's the income that you actually need or want in retirement to live comfortably and live the way you want to. And then what is your Social Security or your pension, and what's the difference there? That difference is going to be your income gap. And we build your safe bucket strategy around that income gap. The goal is to get you that paycheck predictably every single month that you want or you need to live off of. That way, anything else you may have in the market, you don't have to sweat as much. You can let it do what it's supposed to do, which is long-term growth. Just like you did in your working years, we want to give you that same experience in your retirement years. What will your income gap be in retirement? Yours is going to look different than somebody else's. So we take some time to look into it with you to figure out what the best solution is going to be for you. Can be a little bit of a challenge figuring out what is going to happen. And if you're 100% in the market, it can be very, very challenging. So we're going to look at that and prove that to you. So let's look at 2 retirement scenarios with 100% investment in the market. So these 2 individuals are going to start out exactly the same. They are both going to be 100% in the market. They're both going to have the exact same amount of money when they retire. They're both going to be the exact same age when they retire. They're both going to spend down the exact same amount every single year in retirement. The only thing that's going to be different about the 2 individuals we're going to look at is going to be the time frame they retired in. None of us know if we're going to retire in high market conditions or low market conditions. And that's the difficulty if you're 100% in the market. So each of these individuals has $500,000, 100% invested in the market, and taking 5% withdraw off of that $500,000 every year as income. So 5% of $500,000 is $25,000. So in this example, we don't change the income from year to year. We are just taking $25,000 a year off the top every single year as income. So Mr. Blue here, he retired in good market conditions. It was an up market. You can see in the middle here, these annual returns. He was getting bigger annual returns earlier on in his retirement, which made it okay for him to spend down 25 grand per year. I know you can't see it here, but we were subtracting $25,000 from his growth every single year as income. You can see he did just fine. He had plenty of money in retirement. Mr. Red, on the other hand, he's more representative of people over the last 25 years. So he had some big losses early on. So negative 25%, negative 14%, negative 10%. And the challenge with this is he probably spoke with his financial advisor about this and said that, hey, yeah, you can spend down $25,000 a year, needed that money to pay his bills, but he's selling off shares low for 3 years in a row early in his retirement years that never have a chance to recoup again. So he ends up running out of money in retirement. And this happened to a lot of people. And this is the big challenge with being 100% in the market. It's different when you are in your working years. In your working years, you have your paycheck, you have your income coming in to pay your bills. So you can let your 401k or your market portfolio just ride the waves. But when you're in retirement and you need that money, you have no choice. You need to sell off those shares and you can't wait it out. So that's why you need a good safe bucket strategy to pull income from in the down years of the market. Now, how do we do this? What is the solution? It is that safe bucket strategy. So as an example here, the way a safe bucket works and with a fixed indexed annuity, how they work is when the market is going backwards, you do not go backwards at all. You stay the same. You may not go up, but you're definitely not going down. Then when the market's going up, you start to share in those gains. So that green line here. Then market goes down again, you flatline, market starts to go up, you get portions of the gains again. So it's good to have both. The market can be great for long-term growth. That safe bucket can be good to help balance things out and make sure you're not going to run out of money in retirement, or help make sure you're not going to run out of money in retirement, and give you more predictable income and a safe place to pull your money from. So this is nothing new. A safe bucket strategy is something that financial advisors have been looking at for a long time, because we have no idea. If you're 100% in the market, what's tough about that is we don't know what the market's going to do tomorrow, next week, next year. That makes it really tough for income. We know that more than likely 5 to 10 years from now, it's probably going to be higher than it is today. But we just don't know what it's going to do on the day to day. And that makes it tough for predictably getting you the income that you need. So financial advisors have talked about it. So when I worked with that broker dealer, one thing that we looked at, and a rule of thumb that we looked at, is, hey, you take 100 minus somebody's age. So if somebody's 60 years old, 100 minus 60, that equals 40. That means 40% of their portfolio could be in growth or in the market. The other 60% we put into safety. And obviously, this can vary a little bit depending on a person's risk tolerance, how much money they really need as income. There's a lot of factors that go into this, but this is a pretty typical portfolio as we near retirement or as we are in retirement. But the thing that never made sense to me, especially as I started to learn about other options in the marketplace, is the fact that that 60% of safety was typically in something that was not 100% safe. So a lot of times financial advisors are going to put you in bonds or some other option where maybe you can't lose very much, but you still can't gain very much either. So let's say you're getting an average 3% average annual rate of return on the safe portion. So that's 60% of your portfolio. We got to throw in that management fee for the financial advisor. Average management fee across the US for financial advisors is going to be anywhere from 1% to 2%. So we just split it down the middle, call it 1.5%. On a 3% rate of return, subtract out that management fee, you're at a 1.5% total return, and you're not even 100% protected from market losses. When there are options out there that you don't have a management fee, you have zero chances of loss, it started to make less and less sense to me. Now, of course, the financial advisor is going to handle the growth portion. People got to get paid for what they do. It makes sense, but that's what they specialize in, is in the growth side. So why don't we handle it this way? Take that safe portion and put it in options. Most fixed indexed annuities are going to have options where there is no annual fee and there is no management fee tied to them. Some of them do have annual fees. So we always look for the options that don't have the annual fee. If somebody is really, really wanting the highest guaranteed income that they can possibly get, a lot of those are going to have an annual fee associated to them. But first, we look at the non-annual fee options. So let's take that into account here. Let's say that you have no annual fee, no management fee on that 60% of your portfolio that you would have had a 1.5% management fee on. That's helping you out already. Then we already know in a fixed index annuity, you cannot lose any money. And then you're going to participate in portions of the upswing of the market. So there's several different allocations we can put our money into. One will be a fixed account. We can reallocate those funds every single year. The fixed account is going to pay so much guaranteed rate of return. And then there's going to be indexed options. Those indexed options are going to be indexed against, say, the S&P 500. And we're going to get portions of the upswing of the S&P 500 in that example, lock in those gains and never have any losses. So let's say you got a 7% interest credit for the year. And let's say you had $100,000 as an original balance. That $100,000 times 7% interest credit would give you a $7,000 interest credit for the year. Now you're at $107,000. Now let's say the market goes backwards the next year. You're still locked in at that 107. So not only can you not lose your original investment, you can't lose any of your gains either in a fixed indexed annuity. And so you get more of a stair step effect with a fixed indexed annuity instead of that EKG look that you have in the market. And that makes it a lot easier to predictably get you the income that you need. But if we just look at this and we use a fixed indexed annuity with no annual fee, no management fee, participate in portions of the upswing of the market, none of the downturn, and then we let the financial advisor handle the growth portion of your portfolio. And yeah, they're going to have a management fee for that. But look what's going to happen. You're going to have greater growth potential in your portfolio. You're going to have lower fees because 60% of your portfolio now doesn't have a fee connected to it. That 1.5% management fee is gone. And then we've just increased your probability of success of not running out of money because we've protected a lion's share of your portfolio from market losses. So we can predictably get you the income that you want or need in retirement. Now you might ask, well, how do they compare? And the answer is they don't really compare the market versus, say, a fixed indexed annuity. They are completely different options. The market is best for long-term growth, but there's nothing worse for income than the market. Where when we're looking for income, there's really nothing better than an annuity. But if we just want to look at the growth and compare it, if you remember Mr. Blue from earlier, with that 500 grand, 100% invested in the market, taking that $25,000 a year out as income, he got lucky, right? He retired at the right time. He was in the right time in the right place. And he kind of really took the gamble. He was 100% in the market. He had great growth. He had just the best scenario you possibly could have in retirement. But let's compare that to a safe bucket strategy or a fixed indexed annuity only. So with $500,000 and taking 25 grand out per year, you're going to notice that, yeah, on Mrs. Green here, comparatively to Mr. Blue, especially earlier in her retirement, she didn't do as well. She didn't have as much cash accumulation as Mr. Blue. Towards the end of her life, they kind of caught up and equaled out to each other. But Mrs. Green knew that she had a greater chance to not run out. She wasn't doing that coin toss to make sure that she wasn't going to be Mr. Red. Now, the perfect scenario in our eyes is really having a blend of both. That safe bucket portion being a fixed indexed annuity, anything our clients want in growth, having it be in the market with a financial advisor. So how does a fixed indexed annuity work? You've heard me talk about it a little bit, but we're going to try to break it down, make sure it's 100% clear to you. So first of all, you have downside protection. So like I said, you have a fixed account, then you have indexed accounts. Those indexed accounts, the way it works is you can't lose your original investment. You're going to get portions of the upswing of the market. Some of the indexes have caps. So let's say the S&P 500, let's say you have a cap of 10%. You would get 100% of the upswing of the S&P 500 for the year up to 10%. So the S&P goes up 9%, you're going to get a 9% interest credit for the year. It goes up 10%, you're going to get a 10% interest credit for the year. It goes up 14%, you're going to get a 10% interest credit for the year. So you get capped out at that 10%. But in exchange, you're locking in those gains. You're not going backwards. They also have percentages of the upswing of the market called participation rates, where we get a percentage. So let's say it was 60%. Market goes up 10%, you get a 6% interest credit. 20%, you get a 12% interest credit. So there's different ways that they do it, and there's several different options within your contract that we can allocate to. But with those indexes, we get percentages up and we lock in those gains. Then, of course, we have the guarantees. So I talked about that fixed account. Let's say the fixed account pays 5% guaranteed rate of return. Anything that you allocate to that fixed account, you're going to get that 5% rate of return, no more, no less for the year. Then every single year, we can typically reallocate. So most of the options that we look at are going to have a 1 year point to point, meaning how much the market goes up for 1 year is going to be based on how much interest credit that you get. At the end of that crediting strategy, you can reallocate. There are some companies that have 2 year point to points and some that even go longer than that. We don't typically look at those. We want to look at different options that we can reallocate every single year, but it's also going to be up to you and what you think is best as well. We're just going to try to educate you on everything. Now, not every fixed indexed annuity is built the same. It really depends on what's important to you. So some people tell us, hey, you know what? I just want to have the best growth potential that I can possibly have. Don't really care about guaranteed income, but I want to have best growth potential, but also having that safety. If that's the case, we look at options where the actuaries, when they put together the product, they put all of their effort and all of their options that they had into growing your cash as much as they can. So making those participation rates or those caps as high as they possibly can, just to get you the greatest growth potential. Some people tell us, you know what? I want to have the highest guaranteed income for the rest of my life. It'll feel pretty good knowing that I have a paycheck that'll never go away. If that's the case, we look at options where actuaries have put together a plan that gets you the greatest income potential from day one that we can get you, guaranteed income. So if we look at those options, your real cash isn't going to have as much growth potential because the insurance company designed it in a way to get you as much income as they possibly could early on for the rest of your life. And some people really like that. You add that guaranteed income on top of, say, your Social Security. And then if you have a pension, you might be able to completely replace the paycheck that you were used to or the income that you wanted, and you get that guaranteed for the rest of your life, no matter what. And so some people really like that. But it just depends on what's important to you. And those are some of the questions we're going to ask you when we talk to you. A death benefit. So big misconception. A lot of people think about that annuity that their grandparents got, that it worked a lot like a pension, where you would take, say, whatever the lump sum amount was and gave it to the insurance company. Then the insurance company was going to guarantee you so much of a payment for the rest of your life, which can be good. But if you pass away early, it can be bad, right? So let's say you die 2 months in, that insurance company would keep all of your funds. So those were the very first annuities. Those were called single premium immediate annuities. They've evolved a lot since then. There are single premium immediate annuities, which we just don't even look at anymore. Then there's fixed indexed annuities. There are fixed annuities or multi-year guaranteed annuities. They're the same thing, basically. Then you've got variable annuities. You got income annuities with period certain. But the fixed indexed annuities, really the way I like to think about it, it's almost like a CD replacement with a bank. So a certificate of deposit. So you can go up to a bank and say, hey, let's say they're offering 4% guaranteed rate of return if you lock your money up with them for 3 years, as an example. You can put your money with them. That cash is still going to be there at the end. It just kind of locks it up for a period of time where you have, typically with most CDs, no access to any of your funds during that lockup period. Well, fixed indexed annuity, the way I like to think of them is basically like a CD with greater growth potential. So we're tying in the market options of upswings of the market to hopefully get greater growth potential than we could get in a CD. But we're also going to have access to our funds during that period of time. But with a fixed indexed annuity, your cash is still your cash. So there is a death benefit. So just like if you had your money in a CD, or if you had your money in your savings account or your 401k or traditional IRA, and you pass away and those funds go to your beneficiaries, whatever is left. Same thing with a fixed indexed annuity. Whatever cash is left in your account when you pass away is going to go to your beneficiaries. And what's even better about a fixed indexed annuity versus those other options I just mentioned is a fixed indexed annuity avoids probate because it is an insurance product. So all of your other funds are going to get tied up in probate. Probate can take 9 to 12 months or better. And a judge is going to decide if there's any creditors they need to pay off first. They're going to decide where your money is going to go. But in a fixed index annuity, a couple weeks after that death certificate is delivered to the insurance company, those funds are going to end up in your beneficiary's hands. So that misconception of the insurance company keeps your money, that it really is dependent on what type of product that you get. If you get the fixed indexed annuities that we are looking at for you, your cash is still there as a death benefit, just like it would be for your 401k. The only thing is it'd be a little bit better because it'll avoid probate. So will you have access to your money in a fixed indexed annuity? And the answer is yes. So this is another misconception. I had touched on it a little bit earlier, but really I'd like to think of these as a CD replacement, but with some access to your funds. So like I said, with a CD, certificate of deposit with a guaranteed rate of return for a certain amount of time with a bank, typically you don't have access to your funds with those. Well, fixed indexed annuity, the way it works is you have a surrender charge period. It might be 7, 10, or 14 years. It can vary a little bit. Some are 15 years. It just depends on the company. But most companies offer a 7, 10, and 14-year option. And the reason why a person would go with a longer surrender charge period versus a shorter is just for greater growth potential. So the 10 and 14-year surrender charge periods are going to give you higher caps and higher participation rates for greater growth potential inside of your product. But some people aren't comfortable with that, so we just go with a 7-year option. But during that period of time, so let's call it a 7-year surrender charge period, that's just a period of time that you have less access to your funds. But you do have access. So typically the way it's going to work for the, let's say, 7-year surrender charge period, is typically in year 1, you don't have access to your funds at all. Some companies do offer you some, but typically in year 1, you would not have access to your funds without some sort of a surrender charge fee. So you don't want to touch your money in year 1 for most products. Then when we get to year 2, you will have access. And it's typically from product to product. It's going to vary, but it can be anywhere from 5% to 10% of your balance every single year. So if you had 100 grand, and let's say you had a 5% free withdrawal, in year 2, you would have access to $5,000 with no fees whatsoever associated to that withdrawal. Then in year 3, you could do that same 5%. And there's no fees associated to it. If it's a 10% free withdrawal, let's say we have that 100 grand, we're in year 2, then it'd be 10 grand you have access to. Then year 3, you have another 10% that you have access to. But once you get to year 8 in that 7-year surrender charge period, you now can still keep the product if you like it. It's just at that point you would have access to 100% of your funds. So you have a period of time where you have limited access, and the reason for that is because the money is with that insurance company, and they're trying to go get you as much growth potential as they possibly can. So they need some time to do that. So that's why there is a surrender charge period. But what is nice is you do have access to 5 to 10% of your money during that period of time. So really, honestly, if we're talking about an income plan in retirement, you shouldn't be spending more than 5% or 10% down on your money every year anyway, or you're going to be out of money, right? When we're talking about retirement planning. And you don't want to put 100% of your money into an annuity because you want to have access to other funds for an emergency. But during that period of time, 5 to 10% that you can access every single year, get out of the surrender charge period, you can still keep the plan, and then all of the money you would have access to after that surrender charge period. Now, I really want to drive home how the growth potential works inside of a fixed indexed annuity. This can be confusing for a lot of people. So in this example, not taking any withdrawals from the annuity, just want to show you how a fixed indexed annuity truly grows. So let's say the first 3 years here had an interest credit, 8%, 16%, 6%. Then in year 4 or age 69, you're going to see a 0% interest credit. So that would have been a year that the market went backwards. But you're going to notice, so at age 68, she had $663,000 in her account. And then the market went backwards because of that 0% interest credit that year would have meant that the stock market went backwards. However, Her annuity did not. She stayed right at $663,000. And then the following year, got another interest credit. So now her account is starting to grow again because the market's going up again. So again, not only do you not lose your original investment, you can't lose any of your growth either inside of a fixed indexed annuity. Now, going to go over some commonly asked questions and go over those with you. So if there's no annual fee and there's no management fee, how in the world do we get paid? That's a great question. So the way it works is you will not see any fees for commission come out of your account to pay us directly. So if you had 100 grand that you're putting into a fixed indexed annuity, when you see that deposit of $100,000, it's still going to be at $100,000 the day that you purchase it. So got that 100 grand, you put it in the fixed indexed annuity, there's still 100 grand. Then let's say you never had any growth potential, or you never grew any of your money, you stayed at 100 grand the whole time. You wouldn't see that balance change at all. You wouldn't see any money coming out of that account to pay us. So the way it works and how the insurance company can actually do that is they're taking your money and everybody else's money, and now they've got billions of dollars to take to get private placements to go make more money with your money. And so with the profits they are able to make, they're able to pay us directly. So whatever company, we are an independent brokerage, so whatever company you and us decide together makes the most sense for your situation, say you purchase a fixed indexed annuity, that company is going to pay us a commission, but you're not going to directly see that come out of your actual account. Those insurance companies are going to pay us out of the profits that they get through their investments and through creating other insurance products. And can you trust us with your money? So first of all, you never pay us your money directly. So your money would be going to these insurance carriers that have been around since the late 1800s, most of them. So it's going to be, it's kind of like if you went to any of the big financial firms and you work with a financial advisor with them, that advisor doesn't own the company, right? They are just an advisor on your account for that company. Think of the difference being that we have access to multiple companies. We are still just your financial representative of record, your main point of contact, but your actual contract is with whichever company that you purchase that fixed indexed annuity with. And that's where the money goes. So let's say we're taking the money out of your 401k with whatever brokerage that you have that money with. We do a rollover into a traditional IRA, and that money goes directly to that insurance company to fund that fixed indexed annuity. And so that's where the money goes. It doesn't go to us directly. So you're going to be with these big carriers that have been around forever, and they are federally regulated to have $1 of cash for every $1 of liability that they have. Comparatively, let's say we're talking about a bank, depending on the bank, only has to have anywhere from 10% or 10 cents to 40 cents for every $1 of cash for every $1 of liability that they have. An insurance company has to have $1 of cash for every $1 of liability. So they have to be 100% liquid. And most insurance carriers have way more than that $1 of cash for every $1 of liability. They're also reinsured companies we look at, and they're also backed by the state. So you have a lot of security with your funds, and your funds would be with them and not us directly. Now, how does this transaction take place, and will there be taxes? It kind of depends on where the money's coming from. So I already talked about one scenario. Let's say your money's sitting in your 401k, 403b, 457, whatever your employer sponsored retirement account was. Let's say it was a pre-tax account, meaning you've never paid taxes on it. What we're going to do is we're going to roll that over into a traditional IRA. That traditional IRA keeps that money in the same tax code, essentially, meaning there's no taxes on the transfer. And then we're just going to put that money into a fixed indexed annuity. So no taxes on the transfer. Same thing if we're going from, say, a Roth IRA. So if you have a Roth IRA, we do a direct transfer into another Roth IRA. That way it keeps all of its tax benefits, where when you take distributions, you will not be taxed because you've already paid taxes on that money. So if you're in a Roth, we just go Roth to Roth. Then the underlying investment would be that fixed indexed annuity. Then we can also do non-qualified transfers as well. So it just depends on where the money is coming from, and we will help you sort through all that when we speak with you. And will you be there for me in the future? Yes. So we do annual reviews with our clients because most of the options that we look at, you're going to have an interest credit every single year. So usually doesn't make a ton of sense to do a review any more often than once a year, because you're not going to see an interest credit any times more than, once a year. However, if you want to speak more often, you just let us know, and we're happy to speak with you more often as well. If you want to do quarterly, semi-annually, or annually reviews, we're happy to do that, but we will be there for you. So now what happens next, if you want to book a call to speak with us further, I have a team of agents that I have trained on this safe bucket strategy approach. And if you would like to book a call with them, the process would be this. There's a link below that you can click and book a time that is best for you. We just ask that you please pick a time that you know will work. We know that things come up, life happens, but we do have a lot of people, especially in this market condition right now, where a lot of people are afraid of the uncertainty of the market. We have a lot of people coming through right now, and we just want to make sure to make the most of everybody's time. So please pick a time that you know will work for you. But that first call is just a quick 5 to 10 minute call where we're just going to get a better idea of where you're at right now and what your goals are. That way we can go back and look through all of our options to see which solution might be best for you. And then we're going to book another appointment with you that's a little bit longer, where we're going to be able to share our screens with you and show you the plan that we have found for you, and educate you on that plan. That way you can determine whether or not it's a good fit for you. So if you'd like to speak with us and you'd like to learn more, go ahead and click that link below, pick a time that works best for you, and we look forward to working with you soon.